always to look at the future, you also have to look at the past, because as they say, the history doesn't repeat, but it rhymes. So always useful to see data going back as far as available. So that's something we like to do both for markets, economies, companies. If it's an old company, it has data for 50 years, we like to look at that. And so also for the markets. So this is about how 2022 has been so far and what do we expect going forward. So first, a look back. We all know global markets and global economies have not been in the best shape of late. But how good or bad is it in historical terms? You know, that is something that is worth looking at. So this is how the world looks in terms of equity markets. This is as of September end. So 9 months, 3 quarters. Where are we? So the world itself, which is, you know, this is 42 country indices. So the world is at 25.5% down in the first 9 months. S&P is pretty close to that at 24% down, where that is here in terms of number 18 on the list. If you look at NASDAQ, it is at number 35. In fact, a few months ago, it was almost at right at the bottom, 40. The top rank is Turkey, which is, I mean, kind of an anomaly because it is only because it was so beaten down in 2021. So Turkey was ranked 42 out of 42 last year, and it is rank 1. And Sri Lanka is the exact opposite. It was ranked 1 last year, and it is 42 now. Whereas India is at number 8, down in dollar terms for the year, but still better off than most other economies, most other markets rather. And the only countries which are in the green, which had a positive return for the first 9 months of the year, are commodity heavy markets like UAE, Saudi Arabia, you know, Brazil, Chile, that sort, barring Turkey, which I said is like it's just from beaten down levels. Other than that, most markets have done very, very poorly. How poorly? If you look at the S&P itself, it has been down every single quarter for this year. So 3 quarters in a row, first 3 quarters of the year, it has been negative. How often has it happened? In the last 50 years, this is only the 4th time it has happened. So, I mean, keeping that in mind, what does probability tell us that when it is down 9 months of the year with every quarter being negative, what is the likelihood of it being positive going forward? The probability is high. It is not 100%. In 2008, that did not happen. But then in 2008, the real problem started only around the 3rd quarter. So while the first 2 quarters were also marginally negative, the big crash started only in the 3rd quarter. So that continued into the 4th quarter. But in all other instances, it did go up from those levels. So, I mean, I will go into it a little more later, but the economy and stock market are 2 different things. So just hold that thought in your mind and we'll come back to that. So as I said, this is very unusual. Almost the entire world, the stock markets have been a sea of red. And some of it has been, you know, historically bad. If you look at the largest market, which is the US, this has been one of the worst years. And this is equity market. So what has happened on all the other assets? Now, this is even more unusual. So if you look at all assets, see, normally what happens is, and particularly since we keep talking of asset allocation, of moving assets around, or for that matter, you know, in the COVID crash, that is what we did. We moved out of equities into other asset classes, primarily fixed income, and that paid off because fixed income did not fall. Now, again, this has been an extremely unusual year that not only have stock markets fallen, every other asset class has also fallen. So REITs have fallen. If you look at all fixed income indices, which are to the right of your screen on top, you will see every one of them is down around 20%. The very best one is down 15%. So equities are down. If you look at emerging market equities, they are down 28%. S&P, as we looked at, was down 24%. emerging markets, even excluding China, are still down almost 27%. So this is what the world look like. Only green is commodities, and within commodities also, if you look at metals and precious metals, they are in the red. Only energy, which is oil and gas, are in the green. And obviously, I mean, if you are managing funds, you cannot put 40-50% of your fund in oil and gas. That's an extremely volatile commodity, and you don't know where it will go. I mean, the only other thing which you can lens through which you can look at this is that the only good place to be was the US dollar, because on the average, the US dollar has gone up 19-20% against a basket of currencies. So if you when your assets were denominated in US dollars, that was a positive. So that is it. Other than that, again, extremely unusual year that every single asset class more or less is down for the year. Now, again, you know, since long-term data is available only for the US, we go back a century almost, so 1926 to 2022. And we see how many times has the market for both stocks and bonds been negative. And you see in 100 years, this is only the third time it has happened. So it's 1931, 1969, and 2002. That is how unusual this occurrence is. So this is like, as they say, not once in a century, but at least 3 times in a century storm. So now, I mean, either you think that the world is going to blow up and markets are not going to exist, or you know, there is another alternative. So this is the context. So first, almost every stock market in the world is down. Stocks and bonds are down. Almost every asset class is down. Now the question is what to do. For that, again, this is another background that you must look at. Now, always when we talk of risk, we talk of risks of being invested. So whether it is a risk of being in the stock market or the bond market or whichever market, or US, India, we say that, you know, we want to assess how risky is it to be invested. But there is another risk which we don't think of, which is that what if we are not invested? What is the risk in terms of what are we giving up? Now, in our mind, we think that if you are invested in equities, you should get 15-16% return, because you know that's been the long-term return. So if you look at India, that you have proper data from the time the Sensex started, which was in the benchmark for the Sensex is set in 1979. So let us say you invested 100 rupees in 1979. Today it would be, I mean, this data is probably, you know, dated by 2-3 months. Today it would have become 44,000 rupees. So 100 rupees would have become 44,000 rupees. And we just thought that, fine, you got this. Suppose you had missed out on the 10 best days of the market. Now this is 40 plus years. You will say, you know, 10 days is, how will it be relevant in 40 years? But if you miss out on 10 good days in the market, that 44,000 goes down to 15,000. So 2/3 of your returns go. That is how significant it is. If you miss out on 30 good days, which is less than 1 day a year, less than 1 day a year, you give up 90% of your returns, and that 44,000 comes down to less than 3,000, comes down to 3,900. So it is very important that you don't miss out those big days. In fact, you know, we even did an exercise that obviously you will not go in and out of the market in 1 day, but even if you take a month around those good days, even then the result is more or less the same. And the other thing is that when do these big up days occur? This was the other exercise which we did. And we found that these up days occur when the market has fallen or people are despondent, when generally there is fear in the market. They don't occur during a bull run. The only exception we found was 1 or 2 days during the Harshad Mehta bull run, because that was a rigged market. In a normal market, they do not come in the bull phase. And this is not an anomaly of the Indian market. We did the same exercise for S&P, where obviously the data goes back far longer. And in 100 years, same patterns, 100 years, you miss out on 25 good days, 1 day in 4 years. You give up 90% of your returns if you miss out 100 good days. That's 1 day a year. Your returns are actually negative over 100 years. So your $100 doesn't even remain $100. So that is how significant it is. Again, it is not possible to predict these rare days. The other thing which we found, this we have done now a lot of research. We'll publish a blog on this, that looking at how people feel about the market and what happens to the market. So we have found, and these are studies not just about the US, because US is after all one single market, but the studies have been done across continents, in Portugal, in Brazil, in US obviously, and many others. And everywhere the conclusion is the same, that when investor sentiment is very high, when people are feeling good, just as people were feeling good about the NASDAQ last year in 2021, everybody wanted to buy the NASDAQ ETF and the NASDAQ fund and all that. After that, the returns are subnormal. And it is the reverse. When you are feeling not quite sure, when you want to wait, that let the dust settle and then I will get back into the market, after that, the market gives you very good returns. And basically our mind traps us in the wrong direction. This is, we plotted the Nifty 50 versus the net inflows into equity mutual funds. So if you look at equity mutual funds monthly inflows, they just when the market went up a lot. So every time you see when the market goes up, that is when the net inflows go up a lot. So whether it is 2012 or then after that, those kind of levels you saw again in 2020 after the market went up. When the market was at its low, in fact, the flows became negative. And after it had gone up 50%, that is when the people came back into the market. So this is really the problem. And this is, I often, sometimes people tell me that, can you tell us when to get into the market and when to get out of the market? I mean, it's another matter that I or anyone else will never get it right 100% of the time. But even if I tell you, will you be able to do it? I mean, the example I can give you very, very clearly is the COVID crash example, because that was something that was on record. On March 5th, 2020, I tweeted that something very unprecedented is happening in the markets, because at that time schools had shut down in Japan and in Italy. And there were these pictures coming out of the Rome tourist attractions with not a soul in sight. Later on we got used to those visuals, but that was the very first time. And I said, this is something that I have not even heard of, because even during the world wars, nothing like this happened. And we moved our portfolios to a very, very risk-averse kind of positioning. So, depending on the product, we went into cash, we bought insurance, we moved from equity to fixed income, like in our global multi-asset products, where we normally hold 70-80% equity, we went to 8-9% equity, that much of a difference. I mean, I'll come back to what's on the screen, but the point I was making was that on 23rd March, we again tweeted that now it is time to be back in the markets, because the crash had happened. And so, as I often say, that if I told you on March 5th that get out and March 23rd get in, would you have been able to do it? I mean, both mentally and actually in terms of movement of cash. So that is really the problem. And if you had sat on the fence between that March 23rd and got in after that because you had a FOMO feeling, then you would have you would never be able to make up that 30% loss. So the trick in markets is twofold. One is to limit your losses, because that's also important. So as I often say, investing is a loser's game. So first of all, you have to prevent the big drawdown, the big risk, and our systems are systematically designed to do that. And then you have to be there when and make sure you don't miss out on these big up move days. So that's like two sides of the coin. So if I look at the COVID crash, markets were down 30-40%. We lost less than 10% in most of our products. I think in one of the products it was 11-12%. So and like for example, I said we moved from equities to fixed income in our global portfolios. We moved to investment grade fixed income, but when the market crash came, the fixed income also took a hit. So only treasuries were protected. So I mean, we did take a hit, but obviously it was nothing compared to what everybody else, because all other funds were down 35-40%. And once you are down, let us say 33%, you have to move up 50% to come to base zero. So it's very important not to have these big drawdowns. And the second real life stress test was the day the Russia-Ukraine war broke out. That day, the Nifty 500 was down 5%. Our portfolios were down 1.6%. So this is the key, that we do both, that you have to limit the drawdown and then be there when the market goes up to take advantage of that. So I will, before going into what I think today, let me just go back over my big calls over the last 1 year and how they turned out. So last year, same time, for the Diwali special shows, I had said the writing is on the wall that rupee will depreciate in 2022. And then there were a whole lot of reasons for it, including the fact that even by then, most emerging market central banks had raised rates, not just once, but 2, 3, 4, 5 times, and we had not even raised once. I mean, we took a call, yes, that we want to promote growth, but that is the point. That was a call we had taken. Also, if you look at the rupee's own history, either it depreciates slowly every year, 3-4% every year, or it remains in a band and then suddenly depreciates. So that is what we bet on, that is likely to happen, because in macroeconomics, governments and the central bank like to sort of manage all the variables, but you can't manage all the variables all at once. So you want that high growth, you want low interest rates, you want low unemployment, you want low inflation, you want a strong currency. So, but something has to give. And since you were trying to control the other things, I said the currency will give, which, as you know, from 75 we have gone to 83. So that was one call. The second call, which again is on record, not something I'm telling you now. Next slide. Yeah. So which I have been saying from last year again, that India will continue to outperform. So there have been very many media interviews, TV interviews, etc., where I have said very, very clearly in very unambiguous terms that this year India will outperform. And the reason for that was twofold. One, relative to its own history. If you look at, we talked about that 15-16% return over 40 years compounding from Indian markets. That is true, but every decade, the returns have been very different. And 2010 to 20 was the lowest returns. So that decade we compounded only at about 8.5%. And remember, at that time, fixed deposit rates themselves were 8%. So you made no extra returns for the risk you took by being in equity. So we were that far away from that trend line of 15%. So while people said that there's been this big run up after the COVID crash, yes, it has been, but still you were so far away from the trend line, it has not taken you back there. That was one. The other thing was on relative basis also, India, we saw that this year it is number 8, but last year was the first year when after all that time, we were in the outperforming category. Before that, if you see, out of those 42 indices, India some year would be 24, some 25, sometimes 22. So we had not been outperforming for a long time. So once that trend changed, I expected it to continue on an absolute basis. The risk of a big crash comes when you are far above the trend line, not when you are far below the trend line. So that was the second big call. The third big call, again, going back roughly a year, because that was the time these IPOs were very, very fancied. Again, in some of these Diwali shows, I remember talking about at that time, you know, all these Policy Bazaar, Paytm, Zomato had come a little before that, Nykaa, all these were coming, and I gave a very detailed look as to why they will not perform, right from the fact that when you're going for an IPO, most of these, if you look at Policy Bazaar or Paytm or Zomato, all of them had cut back on marketing spend and lost market share as a consequence. So when you are a listed company, you want to show profits or limit your losses, whereas if you're competing with a private player which is still funded by VC money, they don't have those constraints. There were many other things. I mean, the valuations were just crazy. I mean, I saw analyst reports which were talking of justifying valuations on 2035 and 2040 earnings, which are absolutely crazy. I mean, one mantra is that there is only one way to value a security. Anytime somebody is selling you that use this different valuation metrics to evaluate a security, they are not asking you to value the security. They are trying to justify the valuation. And of course, you know, most of these IPOs came not even at the price at which the last funding round was raised, but at 3-4 times that number. So I remember this was on a TV show on ET Now, and Nikunj asked me that if I put a gun to your head, which of these new IPOs would you buy? And I said, even gun to my head, I won't buy any. So this was the third big call. But the most important call which I made was in June this year, which was that you must invest in the markets, that we are in a range. I said, I don't know whether this is the exact bottom, but it is somewhere in the range. And this is the time when I had given also this analysis that we spoke about, that if you miss out 10 good days and 30 good days, that now you are at a stage where there is a danger of missing out one of these good days. And I was just checking the day I made that call, the index was 15,293. So in 2 months, you got that 18% move. But again, you know, even though I had said it on TV, I had written a blog, I had put up a video on our YouTube channel also, people did not take action. You know, people keep thinking कि हाँ भी सोचते हैं, करते हैं, अभी सोच के वापस आएंगे, and then they didn't do it. So you miss out on that move. That is what happened. So these are all calls which are on record. And if you look at globally also, the day the Russia-Ukraine war broke out, the day it broke out, I said the direct impact on commodities and how that affects individual companies or economies is different. So whether, you know, gas for Europe or even for India, you know, certain chemical prices go up or down, or oil goes up or down. Other than that, this impact will not show up on stock markets after 6 months. I mean, I said it very categorically. I don't think anybody else made that call. And again, see, all these calls are not, you know, something I'm thinking about and suddenly this flash comes. This came out of data. When this things were hotting up on the Russia-Ukraine border, we went back 40 years and checked every single big geopolitical event. US bombs Libya, 9/11, the 2 Gulf Wars, Afghanistan, whatever. And we found that in each case, within 6 months, the markets forgot about it. It didn't even show up on the charts. Only residual impact, depending on the region, was on oil or gold. Other than that, nothing. So, I mean, so all this comes from study. It doesn't come out of thin air. Like last year, when all these NASDAQ ETFs and funds were coming, I had said that this is extremely risky because you all are suffering from a recency bias. That you think that you can't go wrong buying Nasdaq. But that is not the case, because there are long periods in history when Nasdaq or any other index for that matter has not performed. So nothing is ever a no-brainer. And the same people who wanted to buy Nasdaq in 2021, in 2022, when it went down 40%, started saying this is too risky and I don't want to be there, which is absolutely the wrong time to exit. So this is what happens when you are swayed by your emotions rather than looking at data. So, I mean, our mantra is only that you analyze data, and data, as I said, doesn't mean that you will be right 100% of the time, but it increases your probability of being right, because you understand the context, you understand how many times something has happened. Like in crypto, I wrote a series of articles last year to explain crypto. And I always, and sometimes at that time, because it was so hot, sometimes on a Twitter space or something, people would ask about crypto. And I had said that if you look at the history of, I mean, only Bitcoin had a history to start with. But even if you look at Bitcoin, there's several times in history when it went down by 70 to 85%. So it's quite clear that it's an extremely volatile asset class. It can again go down by that much. So if you want to buy, you can buy 1 to 3% of your portfolio. And I always used to say that at the most, it can be a tadka to your dal. It cannot be your dal. So that is again, I said, no rocket science. That has been the history of Bitcoin. But when there is a frenzy, when there is a FOMO, people forget about it. And that, unfortunately, also is a problem with professional fund houses and fund managers who want to sell whatever people are willing to buy. So typically what happens is, just as we saw with the mutual fund, that people want to buy when something has already run up. So if you look at thematic funds also, whether it is small cap fund, whether it is industry specific fund like pharma or IT, or whether for that matter, like the Nasdaq ETFs last year, all these come when the retail investor sees that something has gone up and she or he has been left out and they want in. So it's easy way to gather assets for the fund house, but normally it is very, very bad for the investor, because those investments don't make money. I mean, that's the long and short of it. And I feel quite upset that that's how the selling happens of these NFOs and all that. So that is an aside, of course. And so now we come to what we have done, and I hand the mic to Achin so he can walk you through what our products are and how they have done.
Thank you so much, Devina. So I'll talk about the performance of our various products. I'll start off with the India Super 50, which is our equities long-only portfolio under the PMS structure. So the portfolio was launched in late February 2020, and we've taken data from the 1st of March, that is the first full month, because for peers, we only have monthly data that is available, until the last completed month. So a bit more than 2.5 years now. So as you can see, the India Super 50 has consistently and significantly outperformed the benchmark. So 50 lakh rupees invested in the India Super 50 at inception would have become more than a crore now, whereas in the benchmark, it would have been around 82 lakhs. And it's not just the benchmark that we've outperformed. Alu, can you please go to the next slide? Comparing against a benchmark is fine, but that's not enough. Very often, and rightly so, we need to look at what the fund is doing in the broader peer group, and that is what we are showing here. So this is the comparison of the India Super 50 versus other PMS schemes in the multi-cap and the large cap space. So what you see here is, this green line that you see at the top, that's us. And then there's a huge gap. And then all the rest of the players are clustered together at the bottom. That's how steep our outperformance has been. And we'll talk about this in a bit more detail on the next slide. So, whenever you're comparing portfolio performance, you start with returns, obviously. So let's look at returns, So the column in green that you see here So our return, like we just saw, we've not just outperformed the benchmark Nifty 500, but we've outperformed all peers by a significant margin. And interestingly, and unfortunately so, a lot of the names that you see here have not even matched the benchmark Nifty 500. So all of these IFLs, CSKs, Axis, Ambit, Marcellus, Motilal, so they have not even matched Nifty 500 returns, let alone come close to where we are. But Alu, can you? Yeah. So, so return is one part of the picture, right? Unfortunately, when people are comparing performance, the comparison starts and ends with returns. But that is not the complete picture, because when you're looking at returns, what is equally important is to understand what are the risks that are being taken to deliver those returns, because all return is not created equal, which is where the rest of these columns are very, very important. So the risk adjusted return, the column in red, tells you how much return have you delivered for every unit of risk that we've taken here. Risk is defined as volatility. And that shows you how far ahead of everyone else we truly are. We are at 1.71 and there are very few names that are even half that number. Okay, and let alone coming even close to where we are. The next column, very important ratio. Now, we started talking about gain to pain ratio, and it's gaining popularity over time. A lot of people don't want to use it for obvious reasons, which is visible here on this chart. So I'll tell you how the gain to pain ratio is defined. So the gain to pain ratio measures the net gain that the investor has enjoyed divided by the gross pain that the investor had to endure. So the net gain is obviously your overall CAGR over the period, over this 2.5 year plus period. The denominator is the gross pain. So how do you measure pain? Every time there's a losing month, a month in which the P&L is negative, that's a pain that the investor has to endure. So what the ratio does is it adds up all the losses. So over this period, let's say if there are 10 losing months, it will add up all the losses, take the absolute value of that. That is a gross amount of pain that the investor had to go through. Net gain by gross pain, that is what the gain to pain ratio is. Once again, we are in a completely different dimension altogether. And then the last two columns tell you that we have outperformed the benchmark Nifty 500 on close to the maximum number of occasions. So high returns are great, but what's better is if those returns come with a lower volatility, smaller drawdowns, and more consistently. That is the holy grail. And what's important is to understand that we are not delivering this performance because of any person's brainwave or because of luck. It is coming out because of a very, very systematic process and our devotion to that process, which also means that these returns are replicable and repeatable going forward. And then we've drawn a comparison with the mutual fund space as well. So we've taken all the large cap, multi-cap and flexi-cap mutual funds. And the picture does not change much. Once again, the green line at the top, that's us. And then you have all the rest of the layers below us. And if you look at the next slide, the same data numerically, once again, we are far ahead in terms of return alone and far, far ahead when it comes to risk-adjusted return. Moving on, that was our equity portfolio in India. Next, I'll talk about our global multi-asset product. So, not many people offer, I shouldn't say not many, nobody else offers a product like this, where within a single product, as an investor, you get exposure to every single asset class in the world. This product invests in equities, in fixed income, in REITs, in commodities, and even in Bitcoin historically to a very small extent. Just like Devina was mentioning, it can be a tadka to the dal. So, like 0.5% exposure, 1% exposure at opportune times. And then it invests across all parts of the world, starting from the US and Canada all the way to China, Japan, Taiwan, from Australia, South Africa, Brazil to Norway, Sweden, Denmark, basically every part of the world. So as an investor, you don't have to worry about should I be in equities or fixed income, which part of the world, all of that is taken care of by us. And this particular product has a longer history. It's significantly more than 7.5 years now. So the returns have once again been phenomenal over this entire period, where we have outperformed the benchmarks very, very handsomely. So $100,000 invested at inception in the product would have become almost $200,000 now, whereas the benchmark would have struggled to get to even $150,000. We'll come back to what the future holds. I'll hand over to Devina for that. But before that, I just want to spend a quick couple of minutes talking about the various products that are available to you as an investor. So within the PMS umbrella in India, we offer 2 products. It's a very, very simple lineup of products. And, so as a fund house, we don't believe in offering a proliferation of products. We don't want to offer 10 different kinds of products. It's different thematics, sectoral, mid-cap, small-cap, large-cap, because, that is not in the best interest of the investor. Those are just asset gathering methods, because many research studies have shown that at the end of the day, the important decision that an investor, what drives returns, top-down asset allocation basically drives returns more than bottom-up security selection. So if at the end of the day, if the investor has to decide should they be in tech or should they be in small cap or large cap or which part of the market should they be in, then we are not doing our job. It is our job to know which part of the market, which sector, which market cap band should we be in. That's number one. Number two, a lot of these sectoral and thematic funds that you see, they become popular after the big move has happened. And so what ends up happening is, as an investor, you end up entering at the worst possible time, at the peaks very often. So, we don't believe in the philosophy of offering sectoral thematic products, although that's very easy to create and offer, but as a fund house, we don't do that. So coming back to our products within the PMS structure, we have 2 products, the India Super 50, which is an equities long only model that invests in listed equities in India. That's one. And then for people who don't want a full equity exposure, we have the multi-asset allocation portfolio, the IMAP, where the equities part is exactly the same as the India Super 50. And then we have an allocation to fixed income, to commodities for a lower volatility. But it gives you the same high risk-adjusted return. That's in India. Globally, we have a lineup of products. So, we have a global multi-asset portfolio where, like I mentioned, within a single umbrella, you get access to all asset classes and geographies with a minimum ticket size of only $10,000. Sorry, I forgot to mention on the previous slide, in the India PMS, the minimum investment amount is 50 lakh rupees. That is the regulatory minimum, but that can be split across the 2 products. So yeah, coming back to the global products, on the GMAP, the minimum ticket size is $10,000. And, you can take my word on this, there is nobody, not just in India, we have not seen anyone else in the world offering a product like this at the entry ticket of $10,000. It is just unheard of. Now we are also offering a global pure equity portfolio with the same ticket size of $10,000. So, we were flooded with requests from a lot of investors who wanted, pure equity play in the global markets. Once again, it is pure equity, but from across the world. So, if you want to if you have that appetite for pure equity risk and don't want to dilute it with other asset classes, GPT is the place to go. And then obviously we have the Global Freedom Fund, which is an offshore Cayman Island vehicle, which runs a strategy which is similar to the GMAP. The first product that we are seeing here, a apologies, is a typo in the name of the first product. It's actually Global Multi-Asset Allocation Portfolio. Okay, so the GFF is similar in strategy to the GMAP. The only difference is it's like a mutual fund. It's a fund structure based out of Cayman Islands, and because of regulatory reasons, the minimum ticket size is $100,000. There, it is a higher minimum ticket size, but then it offers a few advantages in terms of tax treatment is a bit more favorable. The kind of instruments and the kind of hedging strategies that we have access to within the GFF are a bit more favorable. So usually how people do it is they, get there. The GMAP is the entry point, and then people gradually graduate to the GFF. So once again, even globally, as you would see, it's a very, very simple, very straightforward, and a very effective lineup of products which you can choose from. The idea is very simple. When you come to us with a problem, we believe in offering a solution and not a problem in return that we give you 10 different products and you choose from it. So that's not how we operate. So that's about the products. On that note, I will hand back to Devina to talk about the part that all of you have been waiting for, what the future holds. Back to you, Devina.
One product I think which Achin forgot to mention was that for smaller than 50 lakh investments, we have a product in small case called FG HUM. Oh, yes, the HUM stands for the human plus machine model. So that is there because there was a lot of demand from all of you saying that you are only doing this for the rich, but that is the semi-mandated minimum. So obviously on small case, it is not a discretionary product, meaning we don't actually execute on your behalf. So we only give a recommended basket. But the way we have designed that product, again, as Achin has been saying, we don't want to push back decisions onto you. So we want it to be a one-stop shop for all your India equity needs. So that is the way we designed it, that it should be a portfolio which takes care of your entire investment decisions for Indian equities. Typically, it has between 25 to 30 stocks because, again, I mean, this is not that webinar. We have done it in the past. Our philosophy of how we go about investing, and one large part of that is diversification. Because often people ask me that, you had these great calls on Amazon or HDFC Bank 20 years ago, 25 years ago. Tell us which is the next Amazon or the next HDFC Bank. And my answer to that is that no one knows that what will be a multi-bagger over 20 years. Jeff Bezos didn't know it. Aditya Puri didn't know it. What the best you can do is have a system which chooses a reasonably large number of stocks according to a system. And if you are following a proper approach, then some of them will become multi-baggers, but you don't know which ones. If you knew, then you would have a portfolio of only multi-baggers, but which no fund manager in the world has. Warren Buffett also says that if you take out 8, 9 of my best stocks, my performance was below par. Or if you look at Rakesh Jhunjhunwala, I mean, almost all his money was made in 3 or 4 stocks, Titan, CRISIL, I think Lupin and 1 or 2 others. A whole lot of them did nothing. So that has been our philosophy. That's what we do in our IAS 50. That's what we do in our small case also. And we use the same system, which is our human plus machine system. So the basic work is done by the machine. And then we have the overlay of human expertise. And just as an aside, we have the overlay of human expertise on the investment side, but not on the risk management side. But, that's a talk for another day because that's a whole different subject in itself. So coming back on what the future holds. So I have already told you that this has been an extremely bad year, not just for US equities, but equities across the world, and not just for equities, but for almost every asset class. So the probability from here becomes that you will see positive performance. Is it happening next month? I don't know. It might happen later, but now again, you are in a situation where the risk of being out of the market is probably more than what it is in being invested. And this I say for India, and I also say for US non-tech. Probably in tech, there might still be some risk left. And the reason for that is that as interest rates go up very much, any company which has profits and cash flows further away into the future, which is the characteristic of some of the tech stocks, not all. It is like this, that if let's say the interest rates were zero, as they were in the West some time back, or near zero, whether you get $100 today or $100 5 years from now, you are indifferent. But if the interest rate goes up to 4%, that cash flow of $100 5 years out becomes less valuable. So you are willing to pay less for it. So our risk, but our overall assessment, as we showed you in that 10 best days and 30 best days analysis, that you are in a situation where if you're not invested at all, if you are waiting for the dust to settle, you will miss out on up moves. That's in terms of probability, that's a higher probability event than of a further crash from here of significant proportions. I've already spoken that India will continue to outperform. That for now holds. Again, see, all of what I'm saying is doesn't necessarily hold for the whole year. That is why we say that don't be a bull, don't be a bear, be a hare. You would have seen our mascot is a hare. And why a hare? Because a hare moves fast, but it can also change direction fast. And of course, a hare has 360-degree vision, which one aspires to. You can't say that you have it, but that is what you would like to have. I've already spoken about the third point, that non-tech we expect will outperform tech. We are still uncertain about Europe because there is a lot of economic uncertainty in Europe. And overall, now we are at a situation where in terms of asset classes, we would prefer equity over other asset classes.
Yes, ma'am. So there are quite many questions which have come up from the participants. So I'll start off with the first question, which is where the investor is asking, should we even consider investing more now if one has a 5-year horizon, or is it considered a bad idea to catch a falling knife?
So that is what I spoke about, that at some point you have to make that decision on whether now the risk is in being invested and risking a further crash, or whether the risk is more in being out of the market and missing out on an up move. So my call now based on data is that the latter is more of a risk, that not being invested is more of a risk because you can miss out on a big up move.
So ma'am, there is an additional
whatever
question.
Is your equity, just to add to that, whatever you think is your base case equity allocation, it is time to be to invest that into the markets. It need not be all at one go. If you let's say you want to invest something in India, maybe one third you can do over 3 months.
Yeah. So there is an additional related question from another investor. With recession expecting, do you see it better to invest now or wait for a correction or SIP?
See, the market doesn't give you that kind of one-on-one thing, because what happens is, as I always say, that economy and the stock market are two different animals. I mean, if you look at the US, for instance, do I think that there is still pain ahead for the economy, that inflation will remain high for some more time? Obviously, interest rates will be raised and there's a good likelihood of recession. Yes, I agree with all of those things. But the question then becomes, how much of it is already in the price? If you look at even that COVID crash, in March 2020, if I had said, and I did say that, go back and invest, you would have said that, but there is so much uncertainty, which there was. I mean, if somebody had told you sitting there that 6-7 million people will die in the world, that for the rest of the year, hotel and airline and cruise business will be zero, people won't be able to go out, so they will not be even doing other shopping, you would have said absolutely no chance the markets will go up, but they did go up. So markets and economies sometimes, at least in the same time frame, are not in sync. If you look at India also, I'm not one of those who will say that India is like the ultimate growth story and India has become an asset class and God knows all that I hear, because there are many grave concerns as far as the economy is concerned. Our per capita income has not crossed 2019 levels even now. If you look at free ration or Narega, all of that, people want more and more, which all shows that more people are in distress. If you look at things like two-wheelers, last financial year, two-wheeler volumes were at a 10-year low. This year, of course, I mean, all those things also, there has been some improvement from those lows, but a large part of the economy is still hurting. But as far as the stock market is concerned, one trend which has helped is formalization of the economy, moving more to the organized sector, which means moving more to the listed space. Also, which are the consumers these companies are catering to, because organized sector employees have done well. So, which is why even in cars, you see the higher end cars and the SUVs selling more than the entry level cars. The growth is more at the higher end. So, or if you look at, for example, real estate, the listed real estate companies all deal with the creamy layer. Doesn't mean that the economy, there are no problems. So, in your mind, you will have to at times make a distinction between those two things.
So, ma'am, which sectors and stocks do you like now?
So, if I look at our portfolio, one sector which we have been, I'm talking India now, one sector which we have been heavily overweight now for a year has been capital goods and industrial machinery. I had put up a video on Twitter also yesterday, walking you through the logic of why we like that sector. This is, I mean, we went to overweight last October 2021. That sector had been a beaten down sector since 2009. Its peak was in 2007, and the whole decade of 2010 to 20, it compounded only 2.5%, whereas the Nifty compounded a little over 9%. So that, I mean, we were just waiting, and at some point it will turn. I mean, you don't know, just because something is beaten down doesn't mean it will start performing. But then fundamentals change for the companies because demand started to pick up, partly because of these production link incentive schemes. Some sectors, there was a little bit of this China plus one sourcing, government capex built up. And so from the lows, the demand picked up because they had gone through this very long period of bad news. They had cut out the flab. So as revenues went up, margins also went up, valuations went up, and that has been a great performer for us in the last 1 year. It still remains our most overweight sector. IT, which we were overweight, we are now more or less market weight. We have changed a few IT stocks from large cap to mid cap. And I mean, while I don't have such a, I don't think that, that's an industry that's going down the tube or something. But in the last 5-6 months, the sectors we have added to have been auto, four-wheelers, auto components, a couple of FMCG names. I mean, we're not overweight in FMCG as a whole, but we liked some, like, for example, ITC was the first one we added a few months ago. And textile and chemicals are not sector-wide calls because there are many diverse kind of companies which are lumped together under that head. So there are, for example, chemicals, there are companies where input prices have gone up and there'll be margin pressure. On the other hand, there are companies where the output prices have gone up and they're doing really well. So that's a more, a slightly different kind of picture there, but that's a sector where we do have certain picks that we like. Financial banks and financials, we are not overweight, but just for context, I mean, that's a sector I'm always a little wary of, even scared of, you can say, because I always feel that it's a highly leveraged sector where from the outside, it's very difficult to make a call that there will be no negative surprises. So that's a sector where, in spite of the fact that such a high weightage in the index, we had negligible weight through 2020 and 2021, which served us very well. Like in 2020, this was the only sector that was in the negative. 2021, while it was not in the negative, it went up only half as much as the market. But now I think that, after that long underperformance, things are looking better. Fundamentally, the NPA cycle is behind them. As interest rates rise in the economy, the margins go up somewhat because your loans are repriced immediately. Interest rates go up on loans, whereas on the deposits, it goes up a little slowly. So net, what we have done is we've increased our weight in banks. We are still not overweight, but now we are close to market weight. So that will be broadly what we have changed and liked in the recent past.
So there are some questions on global investing, but let me first complete the questions on India. So there is somebody who's asking, from someone with a 5-year horizon in India, would IS50 be a better option or a multi-asset portfolio?
See, it depends on your risk appetite, your goals, because there are two different things there. One is equity. So it has that higher risk and higher return associated with equity. And IMAP is for people who want dampen down volatility. So the equity part of IMAP is exactly the same as what we have in IS50. But we add on some amount of fixed income, gold, etc., to reduce volatility. So the returns are a little lower, volatility is a little lower. That is the pattern for IMAPs.
So ma'am, there is this question on, do you see whether global markets do better? Is that a better market to invest now or India? And where do you see outperformance?
Okay, so I spoke about that I expect India to continue to outperform. But having said that, I would also say, and this is a general advice I always give, that you must look at your entire investment pie or entire portfolio and look at how it is split across asset classes. So how much is fixed income, how much is equity, how much is gold, how much is real estate, within equities, which geographies, which sectors even within the country. So it is always better to have some level of diversification. Earlier, we didn't have a choice. I mean, Indians could not send capital abroad, but now we have the liberalized remittance scheme. So this decision is not to be taken that next 6 months India is going to outperform, so I should remain in India. On a more strategic basis, you must look at diversifying some of your assets overseas. I mean, this year, of course, I mean, while the markets have fallen a lot, just, the dollar itself has strengthened. So the fall in dollar terms for anybody who was invested in rupee terms has not been that much. But it is, again, as I said, it is not like a decision you make on a 6-month or 1-year basis. But since in any case, you are exposed so much to the India market or the Indian economy, it's always prudent to have diversification outside. And this is something that I understood at a young age because I lived through that Asian crisis of 97, 98. And you saw that, and these were not like basket case economies or countries. These were Asian tigers. Asian tigers were like something you aspired to be. And then they had this macroeconomic crisis. And in 1 year, in dollar terms, these markets fell between 50 to 90%. Taiwan fell 50%, Thailand, I think 70%, Indonesia 90%, South Korea, everybody in that range. And you suddenly realize that suppose you were only in that home country, suppose you were an Indonesian investor, you would have lost 90% of your capital. So that, in fact, was the trigger for us to go for First Global to go global. But I'm saying that having seen that, and it is not just that some economy totally blows up. You look at Japan, the Japanese stock market, it's been 30 years, it has not taken out its high. It has not crossed its high. If you look at India itself, leaving aside all that growth story, the fact is that when I started working in the 80s, the dollar was 12 rupees. Now it is 83 rupees. So in the course of a career, I have seen an 85% plus depreciation. So those are things you have to keep in mind. So on a strategic level, I would say that start, going global. And going global, as I used to say even last year, doesn't mean that buying a NASDAQ ETF, which is why we thought a lot, and it was not easy to offer, as Achin was saying that, and this is not just in India, but nowhere in the world is there a truly geographically diversified multi-asset product that is available for somebody who has less than $1 million. I mean, we have started at $10,000, which is about 8 lakh rupees, because we wanted to give this option to the Indian investor. As I said, the decision on whether or not to go global is not to be made on just a short-term basis, though, as I said, I think India will continue to outperform for some more time. Yeah, Kavita, back to you.
Yes. So, ma'am, there are a few macro questions. What's your outlook on world economic events like inflation and recession, and how will it impact it?
I mean, I don't have total foresight on what will happen, because as someone was asking me about that, when will Fed stop hiking? I said, even the Fed doesn't know at what point it will stop hiking, because that depends on how the data unfolds. But the fact is that when inflation is this high, it does not come down in 1 month or even 1 quarter or 2 quarters. It takes years. I mean, even as of now, the Fed is estimating that even to come close to 2%, it will be 2025. So now, when does Fed stop raising rates? That is again a question, that if you're not close to that 2% inflation, how much in advance will they stop raising rates? A recession probability is extremely high. I mean, if you look at the old technical definition, US already has had 2 quarters of negative GDP growth number. So basically GDP decline. So that is technically already there. But as I said earlier, that the economy and the stock market are 2 different things. So just because the economy is not doing, it still has bad news coming, doesn't mean the stock market has not already discounted it. So at these levels, I am taking a call that probably the stock market has mostly discounted it. That's a global market, or specifically in the US region. I mean, Europe is a different thing. Europe. And as far as concerned, of course, the direct impact is limited. I mean, because while for certain exporting companies, you might see some pressure on orders, but on the other hand, rupee has depreciated. So that's a boost on the positive side. So I don't see India being impacted very, very directly. But as I said, India has its own issues in any case. The only direct impact in India, of course, is the oil bill. Otherwise, we are not globalized to that extent to have a very, very direct impact on the economy.
Will rupee continue to depreciate?
I don't know exactly when it will stop. I mean, right now it is still looking a bit weak. And also you must remember that it has gotten here in spite of the RBI spending a lot to keep it up. In spite of that, it got here. And now RBI will not be able to do it, because again, see, in macro, that is the problem, that you have conflicting objectives. So if you try to prop up the rupee, what happens is that you are buying dollars and therefore mopping up rupees from the market. So you're reducing the rupee liquidity, which you could do up to a point because there was excess liquidity in the system. But now if you see, the credit growth has been much higher than the deposit growth. And now that excess liquidity in the banking system is gone. So now if you try to support the rupee, you will be squeezing domestic banks and domestic liquidity, which RBI would not want to do. And that is what, it gave up supporting a few weeks ago. And that's when you're again seeing this depreciation. So I think there is still some more way to go probably. Okay. Thanks very much to everybody
Most
for
of them
taking
have been
the time on that too, just before Diwali starts. I think Dhanteras is tomorrow, if I'm not mistaken. So wish you all a very, very happy festive season. And may all of you be blessed with peace and prosperity and good health to all your families.
Thank you so much, everyone, for joining in. I hope it was a very, very informative session and all of you had a good time. Thanks a lot.
And you can always contact us for any other questions that may not have been addressed. Actually, I don't know why we didn't put up that screen on our website is firstglobalsec.com. And you can send an email on info@firstglobalsec.com, or we will just send you a mailer with those details. So hope to hear from you if you have anything more to ask. And of course, we are there on the social media also. You can contact through there as well.